Imagine someone offers you a small apartment for $10 million. Would you buy it? Probably not. Not because the apartment is bad, but because the price is unreasonable. Now imagine someone offers you a profitable business at a very attractive price. You might be interested. The lesson is simple. Price matters. And in the stock market, understanding price is one of the most important skills an investor can develop. Today, you'll learn valuation, the process professional investors use to determine whether a stock appears cheap, expensive, or reasonably priced. Let's begin. This isn't just about numbers. It's about the fundamental philosophy of ownership. To master the market, you must first master the art of determining what a business is actually worth beyond the noise of daily price fluctuations. Over the next 30 minutes, we will dismantle the complex world of valuation and rebuild it into a strategic tool you can use every single day. One of the biggest investing mistakes is confusing price with value. A stock trading at $20 is not automatically cheap. A stock trading at $500 is not automatically expensive. Price alone tells us almost nothing. It is merely a number at which a transaction occurs. Value, however, is what you actually get. Imagine two businesses. One generates millions in profit every year. The other loses money. If both stocks trade at $50, are they equally valuable? Of course not. Value comes from the business, its assets, its cash flow, its competitive moat, not the share price. Professional investors focus on what they receive for the price they pay. Think of it like buying a house. The listing price is just the starting point. The value lies in the structure, the location, and the potential for future growth. In this section, we'll explore why the market often misprices assets and how you can spot those opportunities. We must separate the psychological noise of the ticker tape from the cold, hard reality of the balance sheet. This distinction is the bedrock of intelligent investing. By the end of this part, you will never look at a stock price the same way again. We'll look at historical examples where price and value diverged wildly, creating fortunes for those who knew the difference. Professional investors often think differently than traders. They do not ask, what will this stock do tomorrow? Instead, they ask, what business am I buying? Because when you buy a stock, you are buying ownership in a company, a real business, with customers, products, employees, revenue, expenses, and profits. The better you understand the business, the better you can understand its value. This shift in perspective is transformative. You aren't just betting on a green line on a screen. You are partnering with a management team and investing in a productive asset. We will discuss how to evaluate a company's economic moat, that intangible quality that protects it from competitors. Whether it's a powerful brand, a proprietary technology, or a dominant market share, these are the engines of value. When you think like an owner, you become less concerned with temporary market dips and more focused on the long-term compounding power of the business. We'll examine the 4 pillars of a great business: operational excellence, financial strength, strategic vision, and shareholder-friendly management. This is the professional mindset that separates the amateurs from the masters. One of the most popular valuation tools is the price-to-earnings ratio, often called the P/E ratio. The idea is simple. It compares the stock price to the company's earnings. Professionals use it to understand how much investors are willing to pay for each dollar of profit. A higher P/E ratio generally means investors expect stronger future growth. A lower P/E ratio may suggest lower expectations. But be careful. A low P/E does not automatically mean a stock is cheap, and a high P/E does not automatically mean a stock is expensive. Context matters. Always. We'll compare P/E ratios across different sectors. Why a tech giant might carry a P/E of 50 while a utility company sits at 15. It's about the quality and sustainability of those earnings. We'll also introduce the concept of the forward P/E versus the trailing P/E, helping you understand how professional analysts project future value. Understanding the P/E ratio is like having a compass in a storm. It doesn't tell you exactly where to go, but it tells you which direction you're facing. We will walk through several real-world calculations so you can see exactly how the pros use this metric to filter out overhyped stocks. Remember, the P/E ratio is a starting point for analysis, not the conclusion. We'll also touch on the PEG ratio, which factors in growth, giving you a more complete picture. Imagine two businesses. One grows profits by 2% per year, the other grows profits by 30% per year. Should they trade at the same valuation? Probably not. Growth influences value. Investors often pay more for businesses expected to grow rapidly. This is why some technology companies historically traded at higher valuations than mature industries. Investors were paying for future potential. The future matters, because markets are forward-looking. We'll explore the growth at a reasonable price, or GARP strategy. How do you identify companies that have room to run without overpaying for that growth? We'll analyze the life cycle of a business from the high-octane growth phase to the mature dividend-paying stage, and how valuation changes at each step. Understanding growth is about predicting the future cash flows of a company. We will look at how to read revenue trends and market expansion plans to determine if a company's growth is sustainable or just a temporary spike. This section is vital for anyone looking to capture the massive returns of the next market leaders. We'll talk about the Rule of 40 in software and other metrics used to gauge the health of growing companies. Growth is the fuel that drives the engine of valuation. Even great businesses can become poor investments if purchased at unreasonable prices. This is one of the most important lessons in investing. A fantastic company, a brilliant management team, strong growth, strong products. All of these qualities matter, but price matters too. History is filled with examples of investors paying too much during periods of extreme optimism. Eventually, reality returned, and valuations adjusted. Professional investors constantly ask, "Am I paying a reasonable price?" We will dissect famous market bubbles from the dot-com crash to the recent speculative frenzies to see how even the smartest investors can get swept up in the hype. The key is discipline. We'll teach you how to set buy limits and walk away when the price no longer makes sense. Paying a 100% premium for a 10% growth rate is a recipe for disaster. We'll discuss the psychological traps of FOMO and how a solid valuation framework acts as your shield against emotional decision-making. By the end of this part, you'll understand why waiting is often the most profitable action an investor can take. Discipline is the difference between a gambler and a professional. One of the most important concepts in investing is the margin of safety, popularized by Benjamin Graham. Imagine building a bridge. Would you design it to hold exactly the expected weight? Of course not. You would include a safety margin. Investing works similarly. Professional investors often seek opportunities where the price provides room for error, because forecasts are imperfect. Analysis is imperfect. The future is uncertain. A margin of safety helps reduce risk. And reducing risk is often just as important as finding opportunity. We'll show you how to calculate your own margin of safety, buying a stock for 70 cents when you believe it's worth $1. This buffer protects you when a company misses an earnings target or the economy takes an unexpected turn. We'll discuss the intrinsic value and how to estimate it using conservative assumptions. Remember, you don't need to be exactly right. You just need to be roughly right and have a large enough margin of safety to survive the times when you're wrong. This is the secret to sleeping well at night while your capital grows. We'll explore how different levels of risk require different margins of safety. One of the greatest investors in history, Warren Buffett, often emphasizes buying wonderful businesses at reasonable prices. Notice something important: not any business, not any price, a wonderful business, at a reasonable price. This balance between quality and valuation is one of the foundations of successful long-term investing. Professionals seek both: business quality and attractive valuation. We dive into the concept of return on invested capital and why Buffett loves businesses that can reinvest their own cash at high rates. We'll also look at his famous owner earnings metric, which cuts through accounting tricks to show the true cash a business generates. Buffett's wisdom is simple but difficult to execute. Be fearful when others are greedy and greedy when others are fearful. This part will help you internalize that contrarian mindset. We'll analyze some of his most famous investments like Coca-Cola and Apple to see exactly how he applied these principles. This isn't just theory, it's a proven roadmap to generational wealth. Quality is your safety, and price is your opportunity. Mastery requires the patience to wait for both to align. Many investors focus only on stories, exciting products, exciting technology, exciting headlines, But investing is not only about stories, it is about numbers, cash flows, profits, growth, valuation. Stories attract attention. Valuation determines what you are paying. Professional investors understand both. We will teach you how to look under the hood of a compelling narrative. Is the story backed by real revenue? Is the excitement justified by the margins? We'll provide a checklist you can use to vet any hot stock tip you hear on social media. Numbers don't lie, but stories can be used to mislead. By focusing on the quantitative side, you ground your decisions in reality. We'll discuss the discounted cash flow or DCF model at a high level, the ultimate tool for turning future stories into today's numbers. This section is about developing the investing eyes to see past the marketing and into the engine room of the company. When everyone else is talking about the new paradigm, you'll be checking the debt-to-equity ratio. That's the edge you need to win. Professionals do not ask, is this company amazing? They ask, is this company amazing relative to its price? That is a completely different question. Valuation creates discipline. It forces investors to think critically. It forces investors to separate excitement from analysis. And that discipline can prevent expensive mistakes. We'll talk about the importance of having a circle of competence, only investing in what you understand and can value accurately. Discipline also means knowing when to sell. We'll discuss the sell rules professional investors use to lock in gains or cut losses when the valuation thesis no longer holds. Developing this mental toughness is the hardest part of investing. It's about being okay with being wrong in the short term for the sake of being right in the long term. We'll provide exercises to help you build your valuation muscle, making you a more resilient and clinical investor. This is where you move from being a participant in the market to being a master of it. Discipline is the bridge between goals and accomplishment. In the world of finance, it's the difference between wealth and ruin. The biggest lesson is simple. A stock is not just a ticker symbol, it is ownership in a business. And every business has a value. The market price may be above that value, below that value, or somewhere close to it. Understanding valuation helps investors make more informed decisions, and informed decisions create better long-term outcomes. This knowledge is your most valuable asset. It empowers you to navigate any market condition with confidence. Whether we're in a bull market or a bear market, the principles of value remain the same. We'll recap the journey we've taken today and how these pieces fit into your overall 30 days to master the stock market curriculum. You are now equipped with the same framework used by the legends of Wall Street. Use it wisely, use it consistently, and watch your understanding and your portfolio transform. The path to wealth is paved with patience and priced with precision. You've taken a massive step forward today. Carry this mindset into every trade and every analysis. Ownership is the key to freedom. Choose 3 public companies. Research, revenue growth, profit growth, P/E ratio, business quality. Then ask, would I be comfortable owning this business if the stock market closed for 5 years? Begin thinking like an owner, not just a trader. Today you learned one of the most important investing concepts in the world, valuation. You learned why price and value are different, why growth matters, why overpaying can be dangerous, and why professional investors think like business owners. Tomorrow we'll study financial statements, the language of business, the documents professional investors use to understand what is happening inside a company. Subscribe to Wealth Entertainment 21, turn on notifications, and remember, a great company is not always a great investment. Price matters, value matters, and understanding the difference can change your investing future. I'll see you in episode 24. This is your journey to mastery. Stay disciplined, stay focused, and I'll see you in the next lesson.